Morning, Market Chameleons. Thanks for joining us Monday morning, the pre-market show with Will and Dimitri. There's Dimitri. Morning, D.
Good morning, Will. How are you?
Awesome. Can't wait. It's an exciting week, election week. We got a ton of earnings this week. Before we get started, everyone, thanks for joining us. If you're new to the YouTube Live pre-market show, please put your questions in the chat and we will try to get to them. Thumbs up and subscribing to our channel is always helpful and very thankful. With that, D, let's go to the disclaimer.
Yep. Good morning, everybody. Before we get started, keep in mind, Market Chameleon, Will and I, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for. They should be able to answer your questions, provide you with guidance. There's the disclaimer.
Hey, one other thing before we get started, D, just a reminder, we have a webinar tonight. And there's a time change. We are going to be doing it at 4 o'clock today. So for all of you who are registered, you'll be getting an email letting you know of the change. And I will put a link so you can register for it now if you have not received that email.
All right. Thanks, Will.
Cool.
I'm going with that. I'm going to start sharing my screen real quick. Well, I think you have to let go.
All right.
Okay. Hold on. I think I could take it over. Sorry.
No worries.
Let me know if you see it.
It's coming up. There it is.
All right. All right. Good morning, everyone. I think we'll start out, see what's moving in the pre-market hours. And since we've got the election coming up tomorrow, I wanted to take a look at SPY, see how those options are setting up. And we'll take a look at the straddle, maybe the risk reversal to look at the skew. And take a look at the options chain, see how those options are setting up. And I also wanted to take a look at earnings because we've got a bunch of earnings coming up today, tomorrow. This week is still a big week for earnings. So really quickly, let's start out with the pre-market report. These are stocks that are moving into pre-market hours. We got the most active stocks, the biggest percentage gainers, biggest percentage decliners. I'm going to filter out stocks that are higher market cap stocks. And I'm going to use this filter here and take a look what's going on in stocks with a market cap $20 billion or more. And here we see, so 69 of them made the percentage gainers list, 0 right now on the percentage decliners list that meet this parameter. So that looks pretty positive open. You know, that fares better for the bullish side than the bearish side. The one on top, NIO, that's up 12.3%. On 9 million shares, looks like did they have some earnings or they did report some kind of I'm just looking at the headlines here, October delivery update. So looks like they had some news. There was a press release on that one. LU up 5.8%. I don't see anything really that sticks out to me. So I'm going to move on to the unfiltered report. And if there's nothing there that's crazy today, I think we'll go take a look at the SPY. So DBVT, I think that's up on earnings, up 80%. In the pre-market hours, that's a low cap stock, 131 million and $2.58 stock. EIGI up 61%. That looks like earnings as well. I think that's a healthcare stock. So couple, as usual, we got like some lower market cap stocks moving. If there are no questions on it, I don't see anything like really unusual here. I'll just move on to the SPY and to the earnings. Well, did you have anything on it?
No, just Len, who's on most mornings. He's one of the active chatters in the Chameleon. For anyone who have a NEO position, he said they sold over 5,000 units in October. We have Jake on, who lives in Asia. I'm wondering, has he ever even seen one of those cars on the road, one of those NEO vehicles?
Right, this is the one. Let me just take a look here. So there is some news on it. Here we go. Auto manufacturer. It's closed at $30.58. That's trading at $34.22 in the pre-market hours, up almost 12%. We see VWAP price pre-market $33.57. So we're about 75 cents above that. 9.4 million shares trading hands. This is what the pre-market chart looks like. So kind of right now just trending higher. This is the news out here. So I'll let you guys read it. Obviously, the market's taking a bullish outlook on it, but let's take a look really quickly since we're on it. The gap history and what this stock tended to do after a big gap move to the upside. So this is looking in the last 3 years, 12 largest gap moves to the upside. These are the dates of the gaps. These are the gap moves. So we see the average of the 12 largest gap moves is 13.9%. That's comparing to today's 11.9%. So really right there around the average. This is what the stock tended to do after the open. So from the opening to the high of the day, the average move was 6.1%. From the open to the low of the day, the average move was 5.8%. So almost 50-50. You know, they're a little bit skewed more to the upside than downside. And it's from the open to the close of the day, it looks like 50-50. Half the time it closed lower, half the time higher, average gain of 0.7%. So that's how NEO looked like historically from a price return distribution during the trading hours after opening up higher at the pre-market. Any other questions on this?
Yeah, but there's a lot of chit chat. Jake is saying he heard Luckin sold and he's trillions of cups of coffee, which obviously is false, and then saying so he's bullish NEO because any numbers you see out of China, obviously you need to take with a grain of salt. Jake is being funny with some.
Yeah. Well, here's how NEO. Let's just take a look how I'm gonna see if anything else is moving in the pre-market hours in this group. So we're looking at the auto manufacturing group. So here's NEO, never heard XPEV up 9.9% of pre-market. LI Auto and IU, any of these ring a bell, Will?
No,
so
not for me.
Are actually, so we see like, you know, we got quite a few that are moving in a pre-market. I think this workhorse we talked about before, that's Fiat up 2.9%. Let's take a look. So we see here NEO, that's up almost, is that right? Almost 800% in the last 6 months.
Yeah, well, at the midst of the peak of the trough of the sell-off in March and April, you know, they were betting that, you know, the small companies that don't make any money, they were betting bankruptcy on a lot of them. And so NEO got down to, I think, $2 or something.
Oh, wow. All right. Well, we see here, that's a big so up 800% in the last 6 months. That compares to the median return in this group of 51% in the last 6 months. And I mean, in the last year, it's like, you know, that's a ridiculous return, 2,000% compared to the group, -4%. Let's take a look at the fundamentals really quickly since we're on there. So this is NEO. So trading 28 times, price trading 28 times its revenue, price to sales versus 7.5, 7.5 median in that group. Looks like they really don't have any kind of earnings or gross margin. So there's nothing else to really compare here. Anyway, it looks like they had some positive. Huh?
Late March, early April, it got down to like $240 a share.
Wow. Well, what were you saying that almost half of the stocks, listed stocks, it was some big percentage, almost half the listed stocks don't make any money? Is that correct? Something like
it's the largest number in history, and Jake will correct. I mean, it's greater than the internet boom of the late 90s, 2000s. There are so many stocks that don't make any money. Right.
So we got a bunch of stocks right now that are listed, don't make money. We'll see how that turns out. But I'm going to move on to SPY really quickly and take a look at what the options are pricing in for as far as movement goes, because we got the elections tomorrow. I'm going to take a look at the historical benchmark, see what the straddle looks like on a 30-day constant maturity. So I'm going here to SPY. These are the strategy benchmarks. So we see here SPY right now. I'm going to click over here to the straddle. So the straddle this is looking at buying an at the money put and at the money call with a 30-day constant maturity. So that's our benchmark right now. As of Friday's close, so we were down on Friday, volatility ticked up a little bit. As of Friday's close, that straddle would cost 7.7% premium as a percentage of stock price. Okay, so think of it as if SPY was $100 and you bought a straddle, it would cost you $7. You know, if SPY is 200, it costs you $14. So premium, the percentage premium as a percentage of stock price. So 7.7% as of Friday compared to a 52-week average of 5.3%. So we're about 2.4% over that historical average on 30-day. So let's see how it looks like on a 60-day. So on a 60-day right now, that straddle would cost you 10.2% in premium versus 7.5%. So that's about 2.7% over. So 2.7% over, 2.4% over. Close. I don't think there's like a time arb in there yet, you know, calendar spread. But if I saw them spread out wider, you know, I'd start looking at time spreads. Let's take a look at a 90-day. So 90-day right now, it costs you 12% in option premium compared to historical average 9.3%. So we're 2.7% over, right, on that one, 2.7% over on that one. So really right in line with each other. So that, you know, that move is priced in pretty well on those straddles. Here on 120 days out, so going out further, we got the straddle 13.3% compared to a historical average of 10.7%. Again, that's what's 2.5% over. So they're all very close. You know, I don't see any type of, you know, crazy time spread that is a potential, but I'm keeping an eye out on there, because if you have the ability to perhaps either buy the move, sell the Vega, or the other way around, that could, around any event, time spread could be interesting. Let's take a look at a risk reversal. And we will look at from the perspective of how the options are skewed. So we're going to take a look at on a 30-day constant maturity. So options expiring 30 days out. How does the premium for a call option that's 5% out of the money, how does that compare to a put option that's 5% out of the money, right? So we're looking at a call option that's 5% above the current stock price and a put option that's 5% below the stock price. And we're going to compare those premiums against each other. So it's one minus the other. So if you bought, so this is looking at if you bought the call and sold the put, you would receive a credit right now of 0.9%. Okay, so imagine if the stock was $100, you get 90 cents credit, right? If you bought the call, sold the put, $200, 180. So 0.9%, it's premium as a percentage of stock price. So right now we see the skew. It does look like the puts are priced a little bit more than the calls on a relative basis when we compare to the 52-week average. So from a historical perspective, you get about on average 0.6% credit compared to today's 0.9% credit. So for that skew, you're getting a little bit more reward than historical, about 0.3%. Let's take a look at if we went out a little bit further on a 60-day constant maturity, same thing, 5% call, 5% put. Right now you get a 1% credit. That compares to a historical average of 0.8%. So 0.2% difference there from the historical average. 90-day constant maturity skew, 1.1% versus 0.9%. So you're getting a little bit extra there, 0.2%, 0.2% compared to the historical average, so very close to here. So no arbs there yet, or no, I shouldn't say arbs, but no, it's not enough of a divergence right now to make it interesting as far as like the skew goes and the straddle. Let's take a look at maybe
while you're on that risk reversal, and I'm at Pavel's on every morning. He's just asking how would traders use the risk reversal option strategy?
So a risk reversal is kind of letting you know the skew, really, the skew between upside calls and downside puts. So you could have, you might be bullish or you might be bearish. If you're bearish, you would be buying the put, selling the call type of scenario, or you could do spreads. Or if you're bullish, you would be buying the call, selling the put. And the idea is, you're using the difference in the skew to get a little bit extra above the average. Okay, so that's how you would do it.
It's a leverage issue, right? As well.
It's a leverage issue. So some people would go into like a double call spread or double put spread. So because if you buy the call, obviously that, you have a limited risk when you're buying the call. When you're selling the put, then you have an unlimited risk to the downside. I mean, unlimited till the stock gets to zero, right? But anytime you sell an option, you have an unlimited risk, basically. A different way to do it is by doing an upside call spread and a downside put spread. So that would be a double. Here we go. We could even take a look at that. A double call spread. So if you wanted to stay within defined risk, right? So this would be selling. So this would be buying a call spread. So buying on a 30-day constant maturity, buying a call 2% out of the money and selling a call against it 5% out of the money. So you're buying a call spread, and then to help finance that, you would sell a out of the money put spread. So you would sell a put 2% out of the money and buy a put that's 5% out of the money. All right, so that's upside call spread, downside put spread. That would cost you right now 0.5% that's the premium as a percentage of stock price compared to 0.3%. So I could set it up here. You want to take a look at it?
Sure.
So let me take a look at a close to 30-day.
Hey, while Dee's putting that together, remember, if you're new to the Chameleon, subscribing to the YouTube channel gets you alerted whenever we go live with a new webinar or video. And as everyone knows, the thumbs up are always a big deal. So if you feel like we've done a reasonably good job today, please, a thumbs up is always appreciated.
Okay. So I went out to December 11th, and this has 29 days to expiration, so close to 30. I'm going to find, just to get close to where our benchmark was. So here's a call 5% out of the money, $342.50. So let's say you buy this call, right? And then you go down here and to finance it, I'm going to find something 5% out of the money. So the 310 call, all right, the 310 put, and I'm going to the downside. You sell this put. So this is what happened. On December 11th expiration, you're buying the 342.5 call, $6.13. You're selling the 310 put for $8.88. Let's load this strategy. And so this is what it looks like at expiration. So we're getting a credit of $2.75. And since we're getting a credit, if the stock, you see here, remains anywhere between here, so above the short strike 310, right? We're going to keep that credit. Once it goes above our long strike 342.5, then it acts like stock 1-for-1, and then you're just, making money 1-for-1 on the way up. On the downside, you sold that 310 put. So as it falls below 310, it acts 1-for-1 with the stock, except now you're like long stock. It's like you bought SPY at 310, basically, right? So it's like if you do it at one lot, it's like you bought at 310, you bought the stock and it acts 1-for-1. It could go, because you received the credit, it could go below 310 by $2.75 till you break even, right? So it could go a little bit below 310 because you got a credit, but this is what it looks like at expiration, a risk reversal. And the idea there is, if it just sits around here, goes down a little bit, up a little bit, you get that credit. If it really takes off, then you got that upside call. If it tanks, right, you're basically long that stock. So sometimes people just do that because the idea is, well, if the stock fell below 310, I would buy it anyway, right? If that's how if you're thinking that's where I would buy SPY, my first 100 shares. And if it goes up a lot, you're using leverage. So instead of, buying the stock now, you're using the option leverage. So that's what a risk reversal is. Obviously, it has risk. That's why.
Yeah, it's an interesting way to look at entering the market when the market is very scary, because those puts really explode. And
right. So that's why exactly. So you're getting like a little bit extra right now just to enter in that trade from historical averages. But let's say you wanted to limit your downside risk. Maybe you're afraid of like whoosh, we might just go down a lot, really a lot. Then you could go below 310. Let's just say you go to the 305 put, buy back that put. All right, so now you're protected below 305. And to help finance a little bit of that, we bought the 342.5. Let's go to 347.5 and we sell that. So basically what I did was, now I have upside call spread and downside put spread. And I'm going to reload that. So it will cost me $1.10. Keep in mind that's the midpoint, 68 cents. So this way, if it sits here at this point, since we're paying a debit, you would lose money. But if it goes up, you make money here. And if it goes down, you lose money, but you're stopped out. So that would be like a double call spread. If you got it for credit, that would be even better, but that's what it's a double bull spread, right? Double bull spread, because you're doing a bull call spread and a bull put spread. So that's how this would look. Let me take a look at, since we looked at this benchmark, let's take a look at this. So the straddle here right now, the average is 5.3. We're paying 7.7. So that's about 2.4% above the historical average where those options are priced. Let's see what the stock tended to do over a 30-day period. All right. So these are just looking at how the options were priced. Let's see, how often did this stock, move. So I could go over here on the, let's see, price action. Oops. Mouse is moving around. Price action analysis. And let's type in SPY real quick. And let's see in the last 4 years over a 30-day period. So this 30-day period, I'm going to do it in intervals. So this is what happened historically over a 30-day period. It was up more often than down. 67% of the time it was up, 33% down. This is the average move over a 30-day period, 1.6%. But the average, when it moved up, right, the average of all the up moves was 4.42%. When it was down, the average of all the up and down moves was 4%. So this is just to give you, an idea over a 30-day period how the stock tended to move up or down. I'm going to take a look at, because in the last year, I feel with the corona, it's probably been more volatile. So let's take a look in the last 1 year. So we see here in the last 1 year, the average of all the up moves was 6.92%. The average of all the down moves, 8%. So that 7.2, it's close, right? It's close if we get some volatility right now. I mean, it could be all over tomorrow too, right? Is it possible that all the results are in tomorrow? And
I give that a very small delta. Just, Jake's been talking about this morning. There's so many mail-in ballots. I know in Pennsylvania, they're already saying it's going to be a week away, and this is a major state, right? So
So if it's close, yeah, we could be,
Well, yeah.
be more volatile.
Yeah, the only way it doesn't get volatile if Biden just runs away with it, which certainly
Well,
some of the
either
poll
one,
numbers
right?
are showing.
If it's by lot, either way, then it's over. But I mean, right
Yeah,
now it looks like it's close in like Florida, Pennsylvania, all these key states. So let's take a look at the earnings. We don't have that much time.
We
Let's
actually,
see.
while you're jumping over to earnings, we had two active chameleons. One was asking for Square SQ, which has earnings upcoming. The
Okay.
other was asking for EA if you're going to individuals. But
All right, let's take a look at SQ first. So they're coming up November 5th, I think, right? So this is historically, let's take a look at the charts. These, so what we're looking at right now is these bars. That's what the options were predicting to move up or down in either direction. That's why you have, these are the percentage moves here. So this bar that I'm hovering over right now, what it's saying is on August 4th, the SQ reported earnings after the market closed. The actual move, it was up 7.1% after reporting earnings. The options were implying to move up or down 8.9%. So this green bar, that's the actual move to the upside. The bars are just telling you up or down. That's so it was within the range, right? It was within the predicted range. This red bar, that's telling you the actual move to the downside. So we see went up below what the expected range was August 1st. The actual move was negative 14.1% compared to implied move of 7.2% in either direction. So historically, this is what it looked like. The options overestimated the move 69% of the time. The average of the predicted moves going into earnings was plus or minus 8.7%. The average of the realized moves was 5.9%. So in those long-term averages, it looks like there's about a 2.8% differential between implied versus realized. And that's why you see that straddle, right, was only a winner 33% of the time, average loss 16%. Let's take a look at the implied volatility in this stock. Now, again, this is looking from an implied volatility perspective. What did the options do after SQ reported earnings? And since we're looking at implied volatility, we're looking at a 30-day constant maturity, a little bit further out, options that have a little bit more vega. Keep in mind, if you're playing the move, you want the very near-term options that have the most gamma. If you're playing vega, then you go out a little bit further because those options have less gamma, more vega in them. So 30-day constant maturity, on average, day after reporting earnings, implied volatility was down 20%. 1 day before earnings, on average, the implied volatility was 56.3. Day after, average implied volatility was 44.9. 5 days later, implied volatility was 45. So it looks like it just stayed right there, close to where it was the day after. If you're historically looking at the calendar spread, selling the near-term option at the money, buying a further out option that it's at least 20 days further out, that was a winner 78% of the time for an average gain of 73%. That's SQ. What was the other one, Will?
Well, Pavel was asking for, we had an EA question, but there's also a PayPal question. So either one, EA or PayPal.
All right. Which one's coming out further?
EA.
Yeah, EA coming up. All right, that's coming up November 5th. So take same thing here. It looks like the options overestimated the move 77% of the time in EA. The average of the predicted moves, implied moves heading into earnings was 6.4% compared to a realized move on average of 4.4%. So the long-term average here, 2% differential between the implied moves and realized moves. Implied volatility, we'll see if we could get both of them in today. Implied volatility, day after earnings, 30-day constant maturity, average implied volatility crushed 26%. Day before, the average implied volatility was 39.6. Day after, average implied volatility 29.3. 5 days later, looks like it continued a little bit lower, on average 28.6. You want me? Let me do the, what was the other
PayPal.
one?
PayPal.
Right, PayPal. All right. So here's PayPal. It's coming out today after the market close, right?
Yeah.
Looks like half the time the implied move was overestimated, half the time it was underestimated. So we could see over here, on average, heading into earnings, day before earnings, the Straddle was predicting a move of 5.5% in either direction, compared to a realized move of 5.6%. So very close. It's like, that one was like right in line if you're doing like the longer term averages, historical averages. Implied volatility, this looks like the day after earnings, the average implied volatility declined 24%. Day before earnings, average implied volatility 35.2. Average implied volatility day after 26.7. And it looks like it actually ticked up a little bit 5 days later, on average 27.9. So that's really quick. PayPal looks pretty, historically, like priced really in line with what actually happened. So that looks like it was priced really well with the realized moves. No, it's not. I think it's 9:30. So
nice job, Deem. Everyone's looking forward to tonight's show on the stock screening for stocks. Any parting words for everyone?
Thanks everybody for joining us. Have a great trading day. Hope to see you guys later tonight, and tomorrow morning.
All right. Stay safe out there, everyone.